Welcome. This is Money in a Hot Minute, where I answer your money questions quickly. Today's question comes from Anonymous, and they ask, given the current and future interest rate environment, do you think that bonds have a significant role in portfolio construction or not? Great question. So this has become a big topic of discussion since the pandemic started and since interest rates have gone back down to zero and since inflation has kind of gotten a little crazy recently. So the answer is that there can still be a place for a bond allocation in a portfolio, but what a lot of people are doing is they're making that allocation a lot smaller than what they would have, say, pre-pandemic, pre-inflation, pre-interest rate change, etc. They are essentially taking on more risk in their portfolio by still maybe having bonds, because bonds do reduce volatility in a portfolio, okay, generally speaking. But at the same time, with inflation so high right now, with rates being so low, we're seeing negative yields essentially on these bonds. So yes, they are negative yielding. They're not really, helping us out too much. But yes, they are reducing volatility and reducing risk in a portfolio. And they're, generally speaking, if that's something that you want to continue to do and make sure that you don't have to deal with those large ups and downs when they happen, then a bond allocation could make some sense. But with that said, it's tough. This is a very, very tough environment. A lot of people that are constructing portfolios professionally, like people that are financial advisors, investment advisors, they have taken a lot of their clients and moved a little bit more out of bonds and put that money a little bit more into stocks. They're having to take on more risk in the portfolio. So that is happening. It's just a matter of the environment that we're in. The cards were dealt, right? And there's not a lot you can do right now to generate a positive return without taking on some risk, whether that be stocks, whether that be commodities, whether that be cryptocurrency or something like that. So to answer your question, yes, bonds could have a place in the portfolio, maybe like corporate bonds or junk bonds, or those are going to be higher yielding bonds because they're investing in lower grade debt, essentially, like companies that are not investment grade. They don't have as good of credit, some of these companies. So it's going to pay a higher rate for that risk. But, generally speaking, yes, people are moving into more stocks or more risk assets and kind of pulling money out of bonds, just kind of out of necessity to try to hold that purchasing power and be able to still buy enough goods with your dollars, right? All right, so if you have a question that you want answered, please put it in the comments below for me. Please smash that like button for the algorithm so more people can learn about how to manage their money better. And I'll see you in the next video.